Hello, everyone, and welcome to today's edition of YouTube Live. My name is David Hittle. I am a realtor with United Real Estate Louisville, and I am here to talk about the different kinds of home loans available and whether you have saved enough money for your down payment. So there are many different kinds of home loans that are available, everything from the typical FHA loan to jumbo loans, loans that are really expensive, bridge loans for when you buy a house and you want to put a little bit of remodeling into it. You get you a bridge loan. New construction loans, obviously, if you're buying a brand new construction home, et cetera, et cetera. There are many different types of loans out there. However, on today's YouTube Live, I want to focus on 4 different types of loans and provide you some information on them, and then narrow down which is the best loan of them all. And I have an opinion on that. But before I get started today, I do want to say and make it perfectly clear, I am not a mortgage lender. I am a real estate agent. I'm a realtor. So if you have questions on whether or not you may qualify, whether you may be eligible for a particular type of loan that I may or may not talk about today, please get with your mortgage lender. And if you don't have a mortgage lender and you are looking to do purchase or sell or refinance, you can contact me. My information is in the description of this YouTube Live, and I will get you connected to the best lenders that I know of. So first off, I want to start with the FHA loan. FHA, of course, stands for the Federal Housing Administration. And it is a loan that is insured by the federal government, very similar to how your money deposit at a bank is insured by the federal government up to a certain amount. An FHA loan is insured up to a certain amount by the federal government to your particular lender, whoever is loaning the money. The FHA loan typically requires a 3.5% down payment, which is based on the sales price of the home and can last up to 30 years. So your FHA loan, Federal Housing Administration, insured by the federal government, requires a down payment typically of 3.5% of the sales price and can last up to 30 years. So your breakdown of an FHA loan, and how we did this was an FHA loan given over 30 years at 3% without including taxes or insurance. Because in your particular area, even in your particular county, if you're here in Kentucky, you will have different tax rates. And there's just too many to keep up with. So we will just go with 0. And insurance. Insurance prices can depend on your insurance company. So we don't want to cloud the figures with that either. So with an FHA loan at $100,000, after you pay your 3.5%, which on $100,000 would be $3,500, that would be your down payment. With a 30-year mortgage at 3%, you would pay a monthly payment of $531.67. Again, that does not include your taxes and does not include your insurance, your homeowner's insurance. For slightly more, a $200,000 FHA loan, after your 3.5%, which on that would be $7,000, with a 30-year mortgage and a 3% interest rate, provides for a monthly payment of $963.34. And because the loan is insured by the federal government, state governments, including Kentucky here, have instituted programs known as down payment assistance programs. I will tell you my story, my home here. I would not have been able to purchase it without down payment assistance. It is taken, at least here in the state of Kentucky, it is taken as a second mortgage on your home. It's a 10-year loan rather than a 30. And then after those 10 years, it goes away. But it is an additional on top of your regular mortgage payment. It is a second payment that you can, and I make it through my same escrow. I just have to pay two separate amounts. But the down payment assistance program for those who qualify is a good way to get you into your home, and especially for first-time homeowners that qualify, it is a great program. Again, these programs and whether you're approved for this loan vary, and eligibility should be determined by your mortgage lender. So the second loan that is most common, the FHA is one of the most common. One of the other most common loans is the conventional loan. It is similar to the FHA loan, but that it is not insured by the federal government. So if you are in the process of buying a home and your lender is talking about an FHA loan or a conventional loan and you don't know the difference, here's the difference. One is insured by the federal government and one is not insured by the federal government. But there are a couple other differences. The conventional loan, in order to beat the FHA loan, has a down payment requirement of only 3%. So that is a 0.5% lower than the FHA loan. And they did that so that they could compete. The conventional loan used to be a 5%. But I think more people were going with the FHA loan, so the conventional loan wanted to be able to compete. So they reduced their 5% down to 3%, and that's the typical down payment requirement. It can also be up to a 30-year loan. And here's the breakdown in payment for the conventional loan. Again, given over 30 years at 3% without including your taxes or insurance, because they can vary by county and by insurance company. A $100,000 conventional loan, after paying your 3%, which would be $3,000 on a $100,000 loan, with a 30-year mortgage and a 3% interest rate, provides a monthly payment of $589.10. So that is about $58 more than you would pay on the FHA. And then a $200,000 conventional loan, after paying the 3% down payment, which would be $6,000, with the same 30-year mortgage and a 3% interest rate, provides you with a monthly payment of $1,178.20. And that is over $200 more than what the FHA loan is. But here's the difference. The reason for the higher amounts with the conventional loan versus the FHA loan is that the conventional loan charges a higher mortgage insurance payment depending on your credit score. So if you do not pay at least a 20% down payment on either an FHA or a conventional loan, you have to pay mortgage insurance. And that's basically an insurance policy that the mortgage company has on the loan, so that if for whatever reason there is a default, then the mortgage insurance would step in for the mortgage company and pay for that loss, whatever that loss happened to be. So that is the reason for the increase in your monthly payment. With a better credit score, the better your credit score with a conventional loan, the better your mortgage insurance premium will be. So with the FHA, it doesn't matter about your credit score. Whatever your credit score, doesn't matter. Your mortgage insurance premium is based on how much you put down, and it's based on your sale price of the home. With the conventional, it's based on the sale price of the home, but it is also based on your credit score. The higher your credit score, the lower your mortgage insurance premium could be. So that is the difference between the two when it comes to that payment. So again, those with a higher credit score who have a significant down payment, the conventional loan may actually be a better choice than the FHA loan. Again, it all depends on the credit score and the down payment that you have. So again, higher credit score, better mortgage insurance payment, which will also reduce your actual monthly payment as well on that conventional loan. So the third loan that I want to talk about is the USDA loan. And this is for rural areas, country areas, rural, not the suburbs or the urban areas, but the rural areas. The USD loan is a rural housing loan only available for select rural single-family homes in specific areas designated by the federal government. They are federally guaranteed loans and are designed to assist low to moderate income rural housing buyers. The difference is, unlike the FHA loan or the conventional loan, the USDA loan does not require a down payment. So here's your breakdown in payment for a USDA loan. Given over 30 years at 3% without taking into account your taxes or insurance, again, because county by county, insurer by insurer, your payment for taxes and insurance will be different. A $100,000 USDA loan with no down payment, with a 30-year mortgage and a 3% interest rate, provides for a monthly payment of $454.71. So that is lower than the FHA. That is lower than the conventional because of no down payment and because of other factors that are involved as well. A $200,000 USDA loan with no down payment, with a 30-year mortgage and a 3% interest rate, provides for a monthly payment of $909.42. So a little bit less than the FHA, a lot less than the conventional. And the reason for this is because the USDA loan, with the USDA loan, the mortgage insurance payment that you pay is based upon the sale price of the home. So for a $100,000 home versus a $200,000 home, your mortgage insurance payment is less. That brings your payment down. It does not matter at all about your credit score when it comes to that mortgage insurance payment. They don't look at that like the conventional loan does. So this means the higher the sale price, the higher the mortgage insurance will be on your USDA loan. So last but not least is the VA loan. The VA loan is a loan established by the United States Department of Veterans Affairs and is designed to help veterans and their families obtain home financing. Like the USDA loan, the VA loan does not require a down payment. However, unlike the USDA loan, the VA loan has a VA funding fee unless the veteran is exempt in some way. So here's the breakdown in payment for a VA loan. Again, given over 30 years at 3% without taking into account your taxes or insurance, because again, they can vary by county and by your insurance company. So we did this 4 different ways. A $100,000 VA loan with an exemption from the funding fee, with a 30-year mortgage and a 3% interest rate, provides for a monthly payment of $421.60. That's about $110 less than the FHA loan if the veteran is exempt from the funding fee. A $100,000 VA loan without an exemption from the funding fee, so they're going to have to pay a funding fee, with a 30-year mortgage and a 3% interest rate, provides for a monthly payment of $431.30. So just under $10 more if the veteran has to pay a funding fee on a $100,000 loan. On a $200,000 loan with an exemption from the funding fee with a 30-year mortgage and a 3% interest rate provides for a monthly payment of $843.21. So comparing that to the FHA, you're looking at $120 less than what the FHA pays at that $200,000 rate. And then again, a $200,000 VA loan without an exemption from the funding fee with a 30-year mortgage and a 3% interest rate provides for a monthly payment of $862.60. So for a VA loan, you're looking at whether or not you're paying a funding fee or whether you're not paying a funding fee. There's no down payment requirement, but you can make a down payment if you want to. And then if you do have to pay the funding fee with the VA loan, a lot of times that VA funding fee is able to be rolled into your loan, becomes part of your loan. That is unlike the FHA or the conventional where you have to pay that down payment up front. The VA funding fee does not necessarily have to be paid up front. It can be rolled into your loan. So as you can tell from the exempt versus non-exempt breakdown, the funding fee is far less of an expense than a down payment would be under an FHA or conventional loan. And again, it's one that can be rolled into your home loan. Also, with the VA loan, the interest rates are normally considerably better than a typical loan. So when the typical interest rates for an FHA or conventional are around 3.5%, for our military, for our VAs, they were around 3%. So now we're around the 2.81 is what the interest rate hit this week. The veterans can see loans at 2.3% or better, depending on how their credit is and how the lender finds them as a reliable payer. Also, the VA loan has no mortgage insurance. So with the VA loans, they are insured at a higher amount than with your FHA loan or your USDA loan. So the lender doesn't charge a mortgage insurance payment to a VA loan for a VA loan. And that helps significantly bring down the monthly payments considerably. You think about with a conventional loan at that $200,000, you had to pay a $6,000 down payment, and your monthly payment was still almost $1,200. And with the VA loan, either with or without an exemption, you're looking at $800. So that leads me to my conclusion. I believe, in my personal opinion, you can see the VA loan is the best loan if the client qualifies. If you are a veteran and you were discharged, not dishonorably, but you were discharged from the military and you served a certain amount of time in the military, then you qualify for VA benefits. And I believe that the VA loan benefits are the best thing that we have given our servicemen and women that they humbly deserve above anything else. In my opinion, I went and became VA loan certified, just so that I could help our men and women in uniform and ones who have retired, our veterans, with their housing needs. It's something that's really hits me good. So again, while the VA loan has no down payment, it does require a funding fee if the veteran is not exempt, and they become exempt because of combat-related injuries or injuries that occurred while they were in the military. It's something that the VA classifies. So whenever you go for a VA loan, your lender will contact the VA to determine whether or not you qualify for an exemption. However, even if you don't qualify for an exemption, the funding fee is considerably less than a typical down payment would be, and your funding fee in some cases can be rolled into your loan, unlike your down payment, which you have to put down at the beginning. So for a VA loan, you're basically looking at closing costs and your monthly payment. The VA loan also, again, contains no mortgage insurance, so the monthly payments do not include the typical cost of mortgage insurance either. So what I would say is, if you would like to know more about the loans, or if you qualify for them, contact me today, and I will connect you with a lender who can answer all of those questions for you, and we can get you started with the best loan to fit your needs. So speaking of down payments, the VA loan doesn't have a down payment. But speaking of down payments, that is one of the biggest concerns that buyers have, especially first-time buyers have, is how much of a down payment do I need? Popular belief, one of the biggest misconceptions in this world today, is that you have to have 20% as a down payment in order to buy a home. That is false. In most cases, you do not need 20% as a down payment. It would be nice if you had 20% as a down payment. It would eliminate your mortgage insurance on any loan that you had, and it would considerably reduce your monthly payments. But is it required? No. A recent survey by Point to Homes mentions that 74% of millennials ages 25 to 40 said that they are interested in purchasing a home over the next 12 months. And the study notes that 88% say they have significantly less savings than the average national down payment amount, which is $62,600. And I looked at that number, and that number blew me away. I just talked about a $100,000 loan at 3% on a conventional loan. That's $3,000, and then $200,000, that would be $6,000. $300,000 would be $9,000. So I was wondering where they came up with this $62,600. Thankfully, $62,600 is not the amount that every buyer needs for a down payment. If it was, I would not own this home. According to the National Association of Realtors, the median existing home price for all housing types in August was $310,600. So that means that at 3%, you're looking at just over $9,000 on that particular loan. For a 3% loan, at a 3.5%, you're looking at a bit more. In 2019, the median down payment was 12% for all buyers, 6% for first-time buyers, and 16% for repeat buyers. That was back in 2019. That means if a qualified first-time home buyer purchases a home at today's median price of $310,600 with a 6% down payment, in reality, the down payment only amounts to $18,636. In actuality, if you're going with a conventional loan, or you qualify for a conventional loan at 3%, you'd be paying just over $9,000, not $18,000. Knowing there are also programs like FHA where the down payment can be as low as 3.5% of the purchase price for a first-time buyer, that upfront cost could be significantly less, as little as $10,871. For the same home noted above. There are also other programs like USDA and loans for veterans that waive down payment requirements. We just talked about those. The Point to Home study also shares how much millennials have indicated they've saved for down payment. So how much have you saved for a down payment according to this survey? 14% of them had saved $0. So they're going to do what I did and go get down payment assistance, I hope. 47% had saved between $1,000 and $10,000. 19% had saved between $10,000 and $1,000 and $30,000. 8% $30,001 to $50,000. 4% $50,000 to $75,000, and 8% over $75,000. I wish I was them. Over $75,000 sitting in my savings. That'd be really nice. But thinking about that 19%, that is enough between 10 and 30,000 is enough for a 3.5% median down payment for first-time buyers. It's also enough for 6% median down payment for the first-time home buyers. And those over the $30,000 threshold is enough for a 12% down payment on that median existing home price of $310,600. So be careful out there. If you are thinking about buying a home, but you're like, I don't have enough saved up for a down payment, connect with your realtor, because your realtor can disparage the myths that have been out there forever. People still think they have to put down 20% in order to buy a home. On a $100,000 home, 20%, that's 20 grand. Who's got 20 grand sitting around, especially now? I did not. I certainly did not have $20,000 sitting around. I did not. But I was able to buy my home going on 4 years ago now. And now I help others buy their homes and sell their homes. And so I want to be able to help you do that as well if you have a real estate need. So again, be careful. Do not let the big myths about home buying keep you and your family out of the housing market, especially if you're a veteran. The latest survey that I looked at said that only 26% of our veterans own a home. If you are a veteran and you want to own a home, please contact me today. Let's get you into a home. You deserve to be in a home. Let's get you into one. So I thank everyone for watching this YouTube Live today. I hope that it was educational. I hope that you learned something about home loans today. If you have any other questions or you need to speak with a lender, reach out to me. Again, all my information is there in the description of the YouTube Live today. And that is my personal cell phone number. So give me a call, send me a text, and I will get you connected to someone who can help you with your home loan needs. And I will help you to find your dream home and to get you on the path of home ownership. Again, I thank you all for watching. I'll see you all next week. And until then, I thank you all for watching as always. Y'all have a great day.